Hi everyone, welcome to the Penny Pinchers Tips to Financial Preparedness webinar. We're so happy you're here with us this evening. We really appreciate you taking the time to join us. My name is Alyssa Plumer. I'm with FEMA Region 10 Individual and Community Preparedness Team. And we're pleased to partner with our Region 10 states, Alaska, Idaho, Oregon, and Washington, as well as two banks within our states, Bank of America and Northrim. And tonight's presentation is going to focus on banking and budget basics, how to manage debt, what to include when planning for emergency savings, and resources available to help with financial preparedness. This is being recorded and will be available afterwards for those who aren't able to be here tonight. And there are also captions available. So to change the captions or to turn captions on, you can click the settings icon in the lower right corner of your screen. There are different languages available, including Spanish, Vietnamese, Russian, Korean, Chinese, Tagalog, and English. There will be time for Q&A at the end, so definitely make sure to stick around. And as I mentioned before, the first part of the presentation will be focused on banking and budgeting basics, and then the second presenters will be focused more on that emergency savings and emergency preparedness element. So stay around for the whole thing. We have many resources and websites we'll be sharing throughout in the chat, so those will be shared. So keep an eye out on those. There's no call-in option, so please use the webinar link to listen to the presentation outline. And with that, I think I covered it all. I'd love to hand it over now to our first presenters with Bank of America, Dee Tran and Nellie Tran-Holt. So thank you so much and enjoy the show. Nellie, I believe you're still muted.
I am for sure. I totally forgot about it. Sorry about that. So I was saying thank you, Alyssa, and thank you so much, everyone, for joining. I'm really happy to be here. My name is Nellie Tran-Holt. I am a business banking relationship manager with Bank of America. I have been in business banking for over 15 years and have enjoyed helping our clients with treasury and lending needs. I am also joined today by Dee Tran, my colleague in Washington State. He will introduce himself later on. So before diving into the financial presentation that we have for you, just wanted to relate a little bit of information about Better Money Habits. This is an online learning platform that was created in 2003 to help people create habits to achieve their financial goals. From our country's economic crisis that started in 2008, we definitely learned that knowing how to manage your personal finances is not enough. So what do we do now? Are we acting on what we know? Are we saving some of our money? Are we disciplined with paying off debt? Today, as many of us are once again impacted by a new financial crisis as a result of the COVID-19 virus, many have suddenly lost jobs and income, but unfortunately the bills are not stopped, and we may even have more expenses as a result of higher prices for just the basics. Dee and I, along with many other Bank of America volunteers, volunteer as champions for better money habits. We are a special cohort of dedicated volunteers who help to deliver Money Better Habits content to individual and families directly and also through our nonprofit partners. Better Money Habits Volunteer Champions is our premier skill-based volunteer opportunity, which helps us deliver on our commitment to making financial lives better. Working in our communities, we help fuel economic mobility for individuals and families who need it most. Bank of America has listened to consumers, not only its own customers, who wanted tool and expertise to help address the need for financial knowledge. In response, the bank has partnered with education innovator Khan Academy, a nonprofit with the mission of providing free and world-class education to anyone and anywhere. And we developed a finance online learning resource. It's called bettermoneyhabits.com. You should definitely go visit our site. There is a wealth of information there. Better Money Habits offers a simple way to connect people to relevant advice, tools, and guidance that empower them to take control over their finances. Our resources help build knowledge on topics like budgeting, saving, managing debt, home ownership, retirement, and much more, so people have the power to learn and take action. Today, we're going to discuss some practical tips to help you improve how you manage your money, and we will be focusing on budgeting and banking basics. And specifically, we're going to talk about how to manage debt, including debt repayment strategies, banking basics such as different types of accounts and ways to pay, what an emergency fund should cover and why it's important to have one, and how to budget, which you can think of also as a spending plan. So how to manage debt. Some things that, do some do's and don'ts. Do prioritize paying off debt. Although it's tempting to spend money towards something that you want to buy instead of actually debt repayment, the faster you pay off your debt, the less you'll have to pay in interest, and the faster you become debt free. Do pay on time. Paying your bills on time is very important, and it keeps you from falling behind and avoids late fees and interest charges. It also shows lenders that you are responsible with credit. Do stick to a spending plan. If you don't need something, don't buy it. We all do that. I like my shoes, that's for sure. But avoid your impulse buying and stick to your everyday spending plan. At the same time, of course, there are some don'ts that we should follow. So don't just pay the bare minimum. Paying the minimum will make your debt seem more manageable in short time, but you will pay more interest and the less you pay in payments. Don't forget about accounts that you have opened. Even if you're not using an account regularly, it's still important to check and ensure any balances are being paid on time. And we all know the saying, don't shop till you drop. Maxing out your credit card can hurt your credit and can really cause your interest rates to go up. So be very careful. And as you can see on the screen, of the calculations on this slide, it shows just how much more you have to pay in interest if you owe, for example, $5,000 on a credit card with a 13% interest and only pay the bare minimum. So basically, you just make the minimum payment every month. It would take you about 23 years to repay a $5,000 balance. So very important to make additional payments to principal. So here are two proven strategies that can work to pay down your debt: the snowball method and the high rate method. The snowball method, you pay off the lowest balance first. If you have several debts to pay down, this method may help as you reduce the number of debts you have to manage. You may end up paying more in interest this way. However, the snowball method is great if you have trouble sticking to a plan or you need motivation. The high rate method approach is designed to help you pay the least amount of interest charges. With this method, you pay off the debts with the highest rate first. Although it's financially smart to minimize your interest charges, some people might find it more difficult to sustain it because you may have to manage more credit card payments and the pays would take longer to pay off. Whichever your method you choose, I 100% recommend either one of those. It's really your choice, but stick with at least one. So now moving into reviewing a couple of the basic types of checking or accounts that you can use: a checking account and a savings account. I'm pretty sure we probably all have those. With the checking account, you will be given a debit card. You have access to your account directly without going to a branch. You can also use your PIN and take money out of an ATM or make purchases at many merchants. Most checking accounts also come with a checkbook. Some types of payments like rent do require a check, but always remember to record the check number and the amount, and also remember to write it down so you know, keep track how much money you have available in your account. Also remember there are some fees that may be charged for the convenience of a checking account. Depending on the account, you may be charged a fee for not keeping a minimum balance, or for using other banks' ATMs, or for withdrawing more money than what you have in your account. The other type of account, of course, savings account, usually offers higher interest rates than the checking accounts does. However, savings accounts do typically have a limit on the number of withdrawals you can make. And while this may seem inconvenient, the limited access can help you meet your savings goals. So you won't be tempted to spend the money or get an impulse to buy something. Savings account can also be linked to your checking account, so you can easily transfer funds into it. Setting up a regular transfer of even $10 to $15 a month can really easily help you establish good savings habits. And lastly, again, you will also have to watch out for fees on a savings account, because you may be charged if you don't maintain a minimum balance, or you could also be charged if you have too many withdrawals out of the savings account. And I'm going to pause here. With that, I'm going to send it over to my colleague, Dee Tran.
Let me unmute there first, learn from Nelly there. Hi, my name is Dee Tran, a business banking relationship manager for Bank of America. Nelly's colleague, and been with the bank since 2006. I'm super excited to be part of this session. Being able to share what I know is very important for me, because growing up, I did not have the opportunity like this to learn from experts in our field, and I pay dearly for that. Growing up and learning from my mistake on that. So hopefully these contents are helping everyone there, and if one person can benefit from this, I take it as a win on that. So going from what we have here, now that we talk about checking and savings accounts, let's review different ways you can pay for what you buy and the pros and the cons for each of that. So with cash, using cash can help you avoid debt because you're not actually borrowing any money, but it can also be quite dangerous on that. If you lose your wallet or the wallet gets stolen, there's usually no way of getting that money back on that. With debit card, as Nelly mentioned before, that does come with your checking account, and the cost of your purchase is taken directly from your checking account, which may help you avoid overspending or taking on debt. However, it's important for you to track your debit card purchases along with the check that you wrote and other withdrawals from your account to avoid taking more money than you have in your account. And many of these debit cards do come with some form of fraud protection as well. With credit card, when you use your credit card, the credit card company extends you a credit limit that you may use to make purchases. But remember, you are borrowing money from your credit card company, and you must pay some or all of it back each month on that. And using your credit card is a safe way to build credit. But credit card must be used responsibly, because if you carry a high balance on your credit card, or you make a late payment, or just pay the minimum, as Nelly showed in previous slide, you will be paying a lot more interest than what you're thinking you would, and it could even hurt your credit score. And so most credit cards do offer credit card protection as well. So now that we discussed the basic, so let's go and discuss some basic about budgeting. Here's something that you may need to budget for, or perhaps you already have. Emergencies. Without an emergency fund in place, an unexpected car or home repair, or the loss of a job, or a trip to a hospital could force you into debt on that. And another thing to think about is paying down debt. As we discussed earlier, carrying debt can be very costly, and if it's not managed correctly on that, it can get in the way of your savings effort, making it very challenging to purchase the things that you need, or even hurting your credit score. Short-term goals. Things that you want to save might include security deposit for a new apartment, a vacation, a wedding, or even a down payment for a home. To help you save for any of these goals, start by figuring out how much you need and where you need it by. So once you know the amount that you want to save and when you want to save it by, you can then figure out how much you need to save every month or every week on that, depending on when you get paid on that. Saving for retirement, ensuring you have the savings or ensuring that you have the savings to cover your retirement years is very important on that. However, it does take time. The sooner you start, the better off you'll be, and that will make it less stressful down the road. In addition to savings for retirement and bank savings accounts, you can also invest through a brokerage firm. Investing offers potential for a higher return than you get from a savings account, but it also comes with greater risk on that. Investments are not FDIC insured and not bank guarantee, and you can lose your money. And lastly, saving for education. According to the US Department of Education data from 2016, having a bachelor's degree means earning 66% more in money on average than you do with a high school diploma. But college is more expensive than ever, so saving for it is a main key on that. So let's talk a little bit more about savings for emergency, because this is very important, better money habit for all of us. An emergency fund is a safety net that can help you cover unexpected expenses without breaking your budget and without having you to take over expensive debts. Some people call this saving for a rainy day. So when creating an emergency fund, it's important to consider all expenses. Expenses such as housing expense, food, insurance, or loan payment, transportation, or personal expenses like your phone or entertainment. Here are some things to consider when you start your emergency fund on that. Individuals should aim to save at least 3 months worth of expenses to be safe. But if you haven't started your emergency fund yet, even setting aside little money or as much as just 1 month is better than having no emergency savings at all. Families with 2 earners should try to save at least 6 months of expenses. And if you are a family with 1 breadwinner, you should look to save at least 9 months or more. So how do you know how much you need to save on that? So let's say each month you pay $600 in rent and utilities, $200 on food, $100 on insurance, $100 on loan and debt payments, $50 in transportation, and about $200 on phone bills, entertainments, and eating out. So that all adds up to about $1,250 per month. So you ask yourself, if you're an individual, you should save 3 times of that. So it's going to be about $3,750. If you're a family of with two people that works, you times that by 6, and that's how you get there. And lastly, keep your emergency savings in an easily accessible savings account. So now let's spend a minute to talk about budgeting basics. So here is 5 steps that can help you put spending plan in place to get you and keep you on track for financial success on that. 1, know your net income. The first step in creating a spending plan is to know how much money you have coming in. Your gross pay, which is the total amount before taxes are taken out, is substantially more than what your net pay is, which is the actual amount that you get in each paycheck. Making a plan, now that you know your net income, you should forecast what you spend each month, and that's the plan that we talked about a little bit earlier. Track your spending. It's helpful to keep track of and categorize your spending so you know exactly how much you're spending each month and adjusting to that. An easy way for you to kind of keep track of that is by sorting receipts, writing down everything that you spend, or even using a budgeting app on your phone. 4, check your progress. It's important to see where you're doing and comparing that to your spending plan regularly and adjusting your spending or savings plan accordingly to that as well. 5, adjusting your habit if you need it. Now that you made your plan, you can see where you're spending your money. For example, you can also adjust things that you spend each month on that as well. So let's say you're buying lunch each day for $11. If you bring lunch from your home, you can save substantial amount on that. So that could be thousands of dollars each year on that. So at bettermoneyhabit.com, there are several videos and additional resources outlining ways that you can save money and help you get a better spending spending plan on that as well. So make sure to check on that at bettermoneyhabit.com. So as discussed before, it's important to have a budget and know exactly what's coming in and going out each month. This worksheet here is available online along with many helpful resources at bettermoneyhabit.com. It's a great starting point for you to kind of figure out what you're spending, what you're spending each month. So with this worksheet here on a high level, you can figure out how much you're actually spending and if adjustments needed on some of the habit. And with this one here, it's important as first step for you to kind of figure out how much is coming in, how much is going out, how much savings you actually do have on that, and whether or not you are on track to what you have in the spending plan on that. So let's review what we learned today. So we learned that you need to be responsible with credit, pay more than the minimum, pay on time, and don't spend above your credit limit. This will ensure you manage your debt and help you build a positive credit history and a positive credit score on that. Work to repay any debt. Today, we talk about 2 debt repayment strategies that you can use, the snowball method and the high rate method. Third, learn the banking basics. We review checking accounts, savings account, cash, credit, and debit cards. Choose a banking product that fits best for you. And you don't, just remember you don't have to stick with just one product. If that doesn't work for you, try another one that might work best for you on that. And finally, build and stick to a budget plan. It's important for you to know what the income expenses you have each month and making a spending plan that works for you and managing to your need on that. So thank you so much for being a part of this presentation today. Now I hand it off to Angela from Northern Bank.
Hi, I'm Angela from Northrim. I am the Community Development Manager and Loan Compliance Manager. And with my job, I get to do things like this, teach people about financial literacy, answer questions in the community. So I'm really grateful that you guys invited me and happy to be here. So we're going to talk a little bit about emergency financial preparedness and recovery from an emergency. So Dee and Nellie talked about making a budget. So let's say you have your budget, you've got your spending plan, and you don't like where you're at. So where do you start? Where do you start to make those changes so that you can save? Well, first you're going to need to evaluate your current financial situation. Ask yourself if you could sustain 1 month in your home if you lost your job. Or how about 1 month in a hotel or a short-term rental if your home was damaged? Could you rebuild from insurance proceeds or federal grants? Do you know what your insurance deductibles would be? And do you know what it would take to rebuild your home? Next, you want to adjust your budget. You want to recognize savings as a need and pay yourself first. This is really important because if you don't set a savings goal and actually put it in your budget, you are less likely to stick to it. Creating an emergency savings goal. Your goal should be SMART. That's specific, measurable, attainable, relevant, and time-bound. All of these things are important to make sure that you hold yourself accountable and stick to your goal. So what short-term and long-term actions can you take to achieve your goal? Some could be cutting your household expenses, stretching your grocery dollar, hiding your extra. And by extra, I mean bonuses that you may get. Maybe you get an annual salary increase and you are spending fine with what you have. You can actually hide those things from yourself before you even use them. PFD is another one. Some employers even offer direct deposit to be split into multiple accounts. So if you know that you have something coming up extra, you can go ahead and put that into a different account, direct deposit, before you ever see it. You want to involve your family, and this is really important because you need their buy-in in order for you guys to be successful at having an emergency savings. Your kids are really good at budgeting, especially if they're having to budget their allowance and pay for things. Maybe they go with you on shopping trips and you ask them to help you make wise decisions, pick alternatives to more expensive things, and make a game out of it. And once you achieve your emergency goal, continue saving for another financial goal. Just pick a new one. You know, maybe you have an emergency fund and now you want to start saving for college. So how do you cut household expenses? Well, there's several items on here that are good ways to save in your home, and I'll just go through a few of them. Don't let the water run while you brush your teeth. If you hand wash dishes, don't leave the water running there either. Only wash full loads of laundry and dishes. Close vents in rooms that aren't used often. Make sure you turn off your television or radio when it's not in use. Comparison shop for lower auto and homeowners insurance rates. And you can comparison shop for phone rates. The next way to save is by stretching your grocery dollar. So when you're planning your shopping trips, you want to keep a notepad handy, jot down the foods as you run low, and encourage your family members to do the same. Don't shop when you're hungry, or especially with a tired or hungry child. And some of us know exactly how that feels. When you're at the store, make sure you stick to your list. When trying something new, just buy a small amount in case you don't like it. Use in-store flyers to find your sale items. Invest in staples like canned fruit, tuna, sauces when they're on sale. You know, ketchup is a good one if you have kids. Avoid buying pre-cut fresh foods. Use coupons for foods you would normally buy, not coupons for food that you don't need or extra stuff that's not on your list. Buy large package only if you will use it all before it goes bad. This is especially important if you shop places like Costco. Buy store brands whenever possible. And some other shopping tips are plan meals around what is on sale. If you can get a sale catalog or flyer prior to going into the grocery store, you can plan your meals that way. Select canned or frozen foods when they're cheaper than fresh, and share your bulk items and the cost with your family and friends. This saves me a lot. I do love to do bulk shopping because in the long run, it is cheaper. But I find that if I go to Costco maybe and I'm buying fruits and vegetables, things like that, they tend to go bad before I'm able to use them. But I have friends, neighbors, family that also like the same things, the same fruits, the same vegetables. And so sometimes we get together and decide, you know, that we're going to buy things in bulk and we just split it and split the cost. That way everybody saves money. You also want to make sure that you control your spending. Especially during challenging financial times, it's very important to control your spending. Restrict purchases to needed items and go without items that are just wants. Before you buy an item, ask yourself the following questions. Do we already have one? Can we do without it? Can we postpone its purchase? Can we substitute something else that costs less? Or can we use our skills to make it? Finally, if you're having trouble creating your savings goal and saving enough to be able to put into a savings account, you can contact your local, state, and national assistance programs. Maybe you would qualify for some sort of temporary financial assistance, maybe food benefits or child care and education assistance is right for you. You can also talk to housing counselors and maybe get loan modifications. So we've talked about how to save for an emergency. So what happens when the emergency hits? What do you do next? Well, first you're going to want to decide who gets paid first. You want to prioritize your bills, largest to smallest, and then consider the worst consequences if they aren't paid or if they're paid for less than the amount due. Answer these questions to help you decide. What will affect your family's health and security the most? What will you lose if the bills are not paid? What interest rate are you paying? How much do you still owe on the loan? Is a consolidation loan a good idea? And what about your credit record? How is this going to affect your credit? Then you want to prepare to contact your creditors. Once you prioritize your bills, prepare to contact your creditors to work out your payment solution. Determine how much you owe each creditor, how much you can pay each creditor, and when you can realistically pay. Be prepared to explain your situation and any efforts you have already made to pay them. Have a plan for when you can realistically pay them. When contacting your creditors, you want to make sure that you document the conversation or that you write a letter. Stay calm, ask about hardship programs, and be honest with yourself and the creditor. Don't accept any deal that you know you're not going to be able to fulfill. And remember that when you call your creditors, you're just speaking to a person on the other end. You're not talking to a machine. You're not talking to, someone who probably has never been in your situation. We're all human. We've all had to learn financial responsibility. So it's okay to tell them what's going on and how you're going to do your best to fix it. Then you want to review your credit report. You can order a free credit report from each of the credit bureaus once every 12 months and go through www.annualcreditreport.com. This is the only government-backed reporting that is free. There are some other free options to get your credit reports. A lot of times they want you to sign up for subscriptions, or there's going to be some kind of commercial or sales ads. And a pro tip, you can stagger them so that you get one every quarter. There is a temporary change for the COVID-19 pandemic, and that is that all of the credit bureaus are offering free weekly credit reports through April 2022. So now's the time to start getting that and getting used to looking at your credit reports. On these credit reports, you need to first identify and dispute any errors. Even if you're not sure, you think it might be an error, it might be yours, contact your creditors and ask questions, or you can dispute directly with the credit bureaus. Sometimes you can dispute directly on an app or a link on the computer, and you can also do that in writing. And lastly, once you've experienced emergency, you want to evaluate your current situation in order to rebuild your plan. Review your budget and review your spending priorities. Decide what were your successes and where did you fall short. Adjust your savings goal accordingly. Consider credit counseling if needed. And most importantly to me, use your experience to encourage your loved ones to create their own emergency savings plan.
Great, thank you so much, Angela, Dee, and Nellie. That was so much valuable information. I know I'm feeling very motivated to later, maybe not tonight, maybe tomorrow and this weekend, to get some of my budgeting more lined up and look into a lot of these resources you mentioned. So thanks again to all of you for being here and for sharing such valuable information. And shortly we will have time for Q&A, so stick around for that. And hopefully those of you who are watching this saw many of the links that we shared. So feel free to check those out. Those were shared throughout the presentation, and we, I believe, shared them in the chat. So a few more tips or next steps that you can take. Just gather all your financial information along with critical, personal, household, and medical paperwork. So, I know I have a lot of this information around, not necessarily consolidated, so it's important to consolidate it. And I have been using the EFACT, which I'll get into in a minute. It's just one of many toolkits that helps consolidate all this important paperwork. Also, as our presenters spoke to, consider having an emergency savings account if you do not already, just because you never know when you may need it, and it's good to have that money set aside for a rainy day rather than trying to react to the event to get all the finances in order that you need. Also, have cash on hand. So after a disaster, such as a huge storm where the power's out, you might still be able to go to the store, but they may not accept credit cards, or you may not be able to get cash out of an ATM if the power's out. So have those smaller bills at home. Smaller bills, because what if you need some bottled water? You don't want to have to spend a 20 and possibly not get change back. So that's why the smaller bills are important. Make sure you have insurance, whether you're a homeowner or a renter. Look into your different insurance options, as well as health and life insurance, and also looking into flood insurance and any other potential hazards that might not be covered within your insurance plans. And there's all of this information and more at ready.gov/financial preparedness. And let me just drop this in the link for all of you. And I forgot to mention, oh, yeah, Kiana shared it already. I forgot to mention at the beginning of this webinar that it is National Financial Capability Month. That is April, so that was part of the reason we were hosting this webinar. Sorry, I forgot to mention that. And as Nellie had mentioned at the beginning, we know this has been a really challenging year for obvious reasons with the pandemic. And just more stress on people's finances overall. So we hope that you're taking information away from tonight that you'll use in the future. And hopefully it will make it a little less stressful and overwhelming. We also have additional resources. Oh, here's the Emergency Financial First Aid Kit. So if you go to that ready.gov financial preparedness site, you can download this for free. You're welcome to download and print it, or download and fill it out digitally. And it's a fantastic toolkit. I've been utilizing it to keep all of my important paperwork consolidated and organized, so that if I do need it in a moment's notice, I don't have to scurry around and look for all of it. This includes checklists of important documents and forms to compile your relevant information. And lastly, the next slide will show that FEMA, this is the overview of what we've covered. Just in a nutshell: banking and budgeting basics, how to manage debt, what to include when planning for an emergency, as well as many resources available that are out there for you to help when it comes to financial preparedness and financial planning. Now for the next slide, we do have much more information, not just about financial preparedness, but about individual and community preparedness at large. So check out this link. We'll drop it in the announcement in a minute, but there's a dashboard of all sorts of preparedness resources, and we'll also be hosting a link where you can find this recording and these slides so that you can access them after this presentation. And it has our regional contact info as well as our state partners. And if you do have any questions for our guest presenters that are not answered after this, you can let us know and we'll make sure you get in touch with them. So with that, I believe we have time for some Q&A, but before we get into that, I'd love for those of you who are with us to let us know, use the Q&A feature to let us know what you're going to do just to take more steps when it comes to financial preparedness and financial planning. We'd love to see what ideas you have. We'll give you a minute and then we will move into Q&A. Okay, I don't know if I see any, but feel free to let us know. And in the meantime, if you do have any questions, please drop them in the chat now and we'll turn it over to our presenters to answer them. Thanks again for being here, and we hope that you've found this very informational, like I know I have. Okay, so it looks like there's a few. So someone said that they're going to take advantage of the free credit reports. Yeah, that's definitely a great resource. Someone also said, thank you for sharing small bills as a savings. Definitely. So one of the questions is, what increases your credit score? Having no balance or charging some each month and paying it off each month? So I'm not sure which of the presenters wants to take that on.
So I can take that one for you.
Great.
So to increase your credit score, you're going to want to pay things on time. All of your bills, any kind of loan that you have. If you have maybe a credit card that you don't use and you're looking to increase your credit score, you may want to actually use that credit card. Now pay it off every month, but that shows your creditors that you can spend responsibly and pay that off.
Great, thanks so much. Any other questions out there? Okay, well, I think we could wrap things up, but like I said, if you do come up with any questions, please don't hesitate to contact us. Our email is here and we'll drop it in the announcement as well. But thank you so much and have a great rest of your evening, everyone.